Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures page on the screen now. These disclosures can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is all about sharing timely macro and newsworthy geologic updates, both the positive and the negative news on Crescat's activist mining positions. These videos represent the opinions of Crescat as a mining industry and exploration advocate. Our objective is to share the overall geologic progress on our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates. If you want to learn more about our investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. So recently, of course, we've had a breakout in gold, a breakout in silver, and they're, the metals are starting to run. This is very, very exciting. It's exciting because there is still so much incredible deep value, and we believe high appreciation potential in our exploration-focused stocks. And one way you can see both the relative value opportunity and the timing opportunity here, I think, is just to look at the chart of gold compared to the TSX Venture Exchange Index. Most of the mining explorers around the world are listed in Canada. There's a lot of them listed in Australia too, but most of them are listed in Canada on the TSX Venture Exchange. And the Venture Exchange Index is comprised of, there's more exploration mining companies in this index than there are any other companies. Yes, there are also some software companies and a few other companies, but this index is heavily comprised of exploration mining stocks, and it's really the best one that we have as a proxy for exploration mining. So you can see that when exploration stocks get cranking, they can move, and they can move up a lot more even than the price of gold. And by plotting these on the same axis, we can actually see that there are times when the TSX Venture Exchange was going up dramatically more than the price of gold was back in the early 2000s. And look at the divergence today. Gold has broken out to new all-time highs, but the exploration mining index is still kind of plumbing its decade plus long lows. Really, there was a low in 2015, and we had a nice move up in 2016. A lot of people think that was the bottom for the broader mining industry. But then during COVID, we came around and kind of retested those lows, went even lower on this TSX Venture Exchange Index, and it's kind of like a triple bottom-y thing here. We're just building this massive, huge base. In our analysis, we are extremely undervalued. There's 718% upside in this index just to get back to its prior highs in 2007. So gold has already broken out to new highs for the exploration index to get back to its prior highs, 718%. Now at Crescat, we are looking for the best explorers, the companies that are making the new big discoveries that will drive this overall index. And many of the companies that we own in our portfolio are in this index and have some big discoveries. Quentin will be talking more about those, but let's go on to the next. Now in this chart, we're looking at the TSX Venture Exchange Index again, But now we're looking at the dollar volume. So the amount of actual in USD equivalent trading, the money flow coming into these stocks. And what you can see is those two spikes that we had in the index back in 2016 that really continued on to 2018. And during COVID in 2020 and the early 2021, you can see, look at how when the money comes into this space, it doesn't take a lot of money. So we're looking at the inflows coming into the space of from 250 to 350 million dollars of average daily volume. Okay, 250 to 350 of average daily volume into this entire index of largely exploration focused stocks. They're small. They are small, and some of them even micro cap, but they're small cap stocks. But so when you have an inflow of 200 to 350 million dollars per day into the sub industry group of mining stocks, it can really move the overall group, and that's why the overall venture exchange index went up 80% from 2016 to 2018, and it went up 225% in 2020. But remember what we just showed, that to get back to its prior high back in 2007, it would need to go up 700%. So when you think about the billions and billions of dollars of flows of money going into S&P 500 stocks and mega cap tech stocks, compared to this entire industry and the sub-industry group, where it can only take a few $100 million worth of daily flows to get this index cranking, this is what we're waiting for. And what does it take to get the flows going? Well, first it takes gold breaking out, it takes silver breaking out, and it probably takes a rollover, this what we've been calling for, this great rotation. It takes the overall S&P 500 and these mega cap tech stocks, it takes some money coming out of those things to start to attract money into these commodity industries. It takes inflation picking up. But we are starting to see these things. We haven't seen the flows come in yet, but I think it's coming. Let's go on to the next. So this is a chart that Tavi pointed out to me. One of the it's from B of A Equity Quant Research. This is the average recommended allocation to cash by Wall Street strategists. As you know, at Crescat here, we believe we are at or near a major market top, an S&P 500 market top, according to all kinds of valuation and sentiment indicators. This is just one other sentiment indicator of strategists recommending their lowest weighting to cash going back to 2006. It's crazy. Let's go down to the next. Credit spreads. So this is looking at investment grade credit spreads, courtesy of Bloomberg. And we're again at record tight credit spreads. This is a contrarian indicator, something that you see near market tops, ahead of recessions. Everything looks great, right, at the top. Strategists recommend being fully invested in the stock market and holding no cash and not holding any gold at the top. That's just how it works. And it's just another indicator, that contrarian indicator, that we are in very frothy market top type of territory here. Let's go on to the next. The city U.S. economic surprise index. So they have two different versions of this, a hard data version and a soft data version. Soft data is basically surveys, economic surveys. Hard data is actual economic numbers. And when you look at the surprise, good versus bad for the economy, the surprise, there's the hard data is starting to deteriorate, diverge relative to the soft data. So there's still a lot of optimism in the surveys, but the actual economic data that's been coming in has been surprising to the downside. Another potentially important divergence here at a potential market top ahead of something that's getting ready to happen here. Let's go on to the next. So here we're looking at a JP Morgan survey of their clients that is showing that no one's short the 10-year Treasury. We have an almost non-existent short position in U.S. 10-year Treasuries. I point this out because we have a short position in long duration Treasuries. We're long the 2-year note. We're short the 30s. It's a yield curve steepener trade. It's duration matched. This is in our global macro fund, but because of the record length of time that we've been in a period of yield curve inversions, not only is this a signal of an oncoming recession and a potential equity market meltdown, it is a trade opportunity to play the steepening of the yield curve, which happens when you're going into the recession, when you're going into a market crash. And again, we like to be contrarians, so we would much rather be short the long end of the curve when nobody else is short. Well, guess what? According to JP Morgan, no one else is short. Let's go on to the next. This is a chart that Nathaniel put together. Today was another strong employment report. Remember, unemployment is always strong, low, right ahead of recessions. That's what happens. But we look for divergences, and what you're seeing is that in terms of part-time employment for economic reasons, this data is spiking. The year-over-year change, part-time employment for economic reasons. And what does that signal? Again, the shaded areas are recession. So you normally start to see this increasing, right as you're going into a recession. I know it's impossible to believe that we could be going into a recession right now because everything is so great. AI is so fantastic. The stock market is screaming higher, and everyone has jobs, and AI is just a wonderful thing. But we're looking at the economic data. This is what we are seeing. We also see record valuations in the stock market on par with 1929 and the tech bubble in 2000. There are risks and warnings to watch out for, and we're seeing inflation starting to pick up again. This is a wonderful environment, we think, for rotating out of overvalued large cap U.S. equities and into undervalued commodities and precious metals, oil and gas stocks, but especially undervalued handpicked exploration stocks, handpicked courtesy of Crescat and Quentin Henney. What a great time to be putting money to work in precious metals. We think, let's go on to the next. This is my last chart, I believe. And again, it's just another study of market positioning out there. This one from B of A. And it's the positioning, at Crescat, we're value managers. We're value investors. We look for value. There we see a lot of value. We see value in places that other people aren't looking. But where is most of the world positioned right now? They're not positioned in value. They're positioned in momentum. So this is the record underweight now among portfolio managers, according to B of A's research, in momentum stocks versus low PE stocks. So managers are the most underweight low PE stocks relative to momentum that they've ever been. These are the contrarian types of of signals and positioning that we like to look at. We want to be opposite the crowd. When no one else is invested in value, and when everyone's invested in momentum, that's when we like to be short momentum and long value. And that's basically what we are in our global macro and our long short portfolios, both of which are performing very well month to date, by the way, and had a great month last month. I know we at Crescat, we kind of been going, fighting some of the trends here, sticking with our principles and what we believe, in the last year plus. But I think that conviction and that commitment and consistency to our core position and our values, I think it's going to pay off, and it's starting to pay off now. So that's all I have. Let's flip it over to Tavi.
All right, well, let's get started. Look, I'm always trying to look for ways to talk about something fresh that is happening this week, but also that emphasizes some of the views that we have in the markets. And if you read the news, in fact, on the Wall Street page, actually the front page of the Wall Street Journal today, and I'll read, it says, indexes fall as Fed officials cool talk of easing. And I also read all sorts of things in a Wall Street Journal and, anything I can get my hands on. But ultimately, it always comes down to doing your own analysis. And by watching the entire interview and also the speech of the Fed chair, Jerome Powell, here's a quote that stood out to me that I think it's very important. And he was referring to this, addressing the developments of the last 2 months in terms of data. He said, this recent data does not, however, materially change the overall picture, which continues to be one of solid growth and strong but rebalancing labor market. And I highlighted this section. And inflation moving down toward 2% on a sometimes bumpy path. So in other words, he didn't really change his views regarding the new data that came in. In markets, it's very important. As you gather new data, the facts can change. And let me present to you the reasons why I believe the facts have changed when it comes to inflation. Let's go to the next chart. And so here you're looking at commodities, and it's one of the most important metrics when you're trying to understand where inflation is headed. And in this chart, you're basically looking at equal weighted index of different commodities. And you can see the first wave of commodity prices surge back in 2021, and that was caused by many reasons. That was the first inflationary wave we've had in a very long time, and potentially caused by the fiscal and monetary stimulus. And then we had this invasion of Russia in Ukraine that also caused a panic, in which also drove commodity prices even higher at that peak level that we saw back in March. And now we're starting to see some commodities actually making new highs, which is causing the overall index, as you can see in this chart, potentially experiencing a second wave of inflation. And so for Jerome Powell saying that inflation is going back to 2%, I do think this is a very important metric to be watching for. Let's go to some other ones. Here is another one, oil. So if we break down with oil, energy is one of the most important components of CPI. And I understand that the Fed and other policymakers like to pay attention to core numbers of inflation, but that doesn't change the picture of the consumer, in which has suffered for many years now with the fact that the cost of gasoline and oil overall has been to levels that we haven't seen in many decades. And so now you're seeing here, despite the fact that in the last few months, investors have been incredibly bearish in oil, we're seeing oil actually breaking out. This is a really important development as well, because it is in line with what's happening geopolitically, what's happening with Iran and Israel, especially, and the recent problems that we've actually been hearing about, but also the fact that we know that that production has been incredibly constrained globally, not just in the U.S., and the push towards the green revolution causing one of the biggest movements we've seen of capital flows into energy, which I think that that's going to spread towards the metals and mining industry at some point as well. There's a reason why Warren Buffett owns energy companies, and I think that that's just the beginning of a movement. Nonetheless, this is highly inflationary. Let's go to the next chart as well. And one of the things you can see about, well, where can we see oil trading one day? Well, I like to look at different types of roadmaps. You can never know what's a price target for something, but in the macro world, you're always looking for things that usually lead an index. And one of the things you can look at is equity performance of oil companies that have been very resilient. In fact, they are actually above the levels that we saw during that Russian invasion period. Remember the first wave of inflation, which peaked during the invasion of Russia in Ukraine? Well, the energy stock prices are already at those levels. If we see the blue line, in this case, WTI oil prices going to those, reaching that same price that it was back in June of 2022, it would imply an appreciation of about 50% in oil prices, in which I think it's highly probable, actually. Let's go to the next chart. And so another way to see this is inflation relative to agricultural commodities. Agricultural commodities have a large impact in food prices. I don't think I really need to emphasize this, but certainly we've seen the link between the red line and the white line, which is the red line is agricultural commodity prices, and that's calculated by DPA. Somebody sent me an email asking to describe what am I using as the red line. And please just look at the chart. There's, I usually label these things very descriptive way. So look at the chart. It's right there, DBA ETF. If you want to know what DBA ETF is, Google DBA ETF. And this is not an advertising for Google, but you can figure this out quickly. And what you can find here is that there's a 3-month lead on the data versus CPI, and which gives me a strong conviction that CPI is likely to be bottoming here very soon. And the red line, which is the agricultural commodity prices, as shown in the chart, is up about 21%. Already on a year-over-year basis. If you look at the actual chart, not the year-over-year change of the price, which is what you're looking at, it's actually at record levels right now. I shouldn't say record because it has been higher in the past, but I should say that it's actually at least at a 2-decade highs currently. And so those are other important metrics that if I was the chair of the Federal Reserve, I would certainly be looking at those numbers very closely. Let's go to the next chart. And so if you looked at the global freight cost as well, which is another one that I like to kind of point out, this second wave idea, where does the waves come from? Well, the waves come from studying back other inflationary eras, the 70s, the 1910s, or the 1940s, and understanding how those inflationary periods actually work through waves. And that's a mathematical reasons behind that, but also psychological reasons behind that. And now we're seeing this potential upward movement in world container index cost, in which I think will have also highly inflationary implications, along with what's happening with the escalation of some of the 2 wars happening actually in the world today. So let's go to the next chart. And let's talk about one that is perhaps a little more technical that not a lot of people look at outside of the macro community, which is called the money velocity. Usually people like to say that the reason why we're in the disinflationary period is because money velocity has been collapsing. Well, that has not been the case in the last 2 to 3 years. In fact, we're seeing a major turn in money velocity recently, in which I think it's signaling a bottom for money velocity and potentially the beginning of an upward trend. We don't know yet if that's the beginning of upward trend. Obviously, it's one of those that we're going to have to watch and see. But if you ask my opinion, and if you ask what the pillars of inflation could be causing, is that this white line is poised to be on an upward trajectory for the next decade. And so this is an important one that will also have a very strong impact on inflation. If I was the Fed chair, I would be looking at this chart as well. Let's go to the next chart. So if you look at the Fed funds rate expectations, which supposedly was seen as hawkish, are still expecting almost 3 three cuts on the Fed funds rate for right now. And so despite the fact that we've seen the cuts actually decreasing, the number of cuts decreasing from, I believe it was 5 or 6 at its peak, now back to 3, it still is supposedly a Fed that has turned from overly hawkish to now supposedly more dovish. So let's go to the next chart. So I actually beg to ask this a very important fundamental question. Why has the Fed turned dovish? Well, there's so many reasons. Some people like to say the political reasons behind it. Let's not get political here, although I think there is a lot to do with that. Let's go to the next chart. This is the main reason, perhaps, why the Fed has been forced to also move, is because we're facing a trifecta of macro imbalances. And so here you're looking at a chart that shows the rise of the cost to service the debt, which is basically looking at, not basically, it's looking at the interest payments relative to GDP, which has been surging recently. And the other side of it is how much has the Fed ownership of the U.S. Treasuries outstanding has been changing over the years, and we're seeing a decline. And this chart, to me, is completely unsustainable. Given the imbalances we have in the world today, the one institution that is responsible for all this is the Fed. And so they are likely to see that red line at some point increasing. But let's go to the next chart here. And we're seeing on the back of one of the most restrictive monetary policies in history, at least how it has been labeled as by the media and even by the Fed, the U.S. monetary base has just increased by about $53 billion in the last month, or in the last report of this index. And also, it's been up about $600 billion since the beginning of the year of 2023, or February 2023 to be specific. So what do you think would happen if we see a recession with this metric? And you may think, well, this is just a U.S. phenomenon. No, it's not. Let's go to the next chart. In the next chart, you can see the Bank of Japan assets increase on a weekly basis, and this is looking at in Japanese yen terms. It is we've seen a spike in the data recently, which was about $80 billion worth. So now we're back to US dollars, $80 billion worth of an increase on 1 week in their balance sheet assets. And you can see here, there are so many reasons behind other increases in the past. One of them was when they decided to increase the cap of their 10-year yield. The other one was during the COVID recession in 2012 and 2013 was regarding what they called the DOJ introduced a qualitative and quantitative easing policy at that time. And then we've had the European debt crisis back in 2010 and 2011. And then the tech bust as well caused the Bank of Japan, or the BOJ, increase the number of its assets. And so let's go to the next chart. And another one, just to point out quickly, that I've been showing this in the past, is the PBOC. China has also been increasing the size of the balance sheet, which is of a lot of importance as well. Let's go to the next one. So one of, I think, most structural issues happening in markets in the global economy is this chart, is the chart of the divergence between gold and treasuries. Gold is making new highs and treasuries making almost new lows. Not exactly a new lows yet, but if you ask me, we're probably headed towards that. And so what is really going on? I believe central banks are starting to show their cards and starting to accumulate gold in a large way. But more importantly, let's go to the next slide. Why are treasuries falling? It's a very important question. Let's go to the next one, because I give, if we're taking a test and a multiple choice test, and you have to pick one of them, which one would you pick? I know what you're probably going to say, Quinta. You would probably circle the whole thing. But no, the answer is in the following slides. But here is, I just suppose if you study economics, they usually talk about different types of risks, which one of them is kind of stupid, that they say rising interest rates, obviously, because the price of the bond is linked to the interest rate level. So I don't really understand that, but the demand falling and the inflation risk, the credit risk, and the supply rise, those are to me the main ones if I would pose here. Let's examine each one of them. Let's go to the next chart. So inflation. So here you're looking at the 10-year yield rising, but inflation expectation, this is what the market thinks inflation expectation or inflation will be 10 years from now, is at about 2.3%. So is the white line increasing because inflation is reaccelerating? No, that's the answer right there. It's right there in your chart right here. Inflation is reaccelerating, in fact, but we're not seeing that really translate into higher 10-year yields. If that was the case, the blue line would be rising in tandem with the white line, and we're seeing a big divergence between the two as of late. And so I think that we're yet to see the downward pressure coming from inflation. That's my point. There's more of a downward pressure to come, especially if inflation continues to stay higher for longer, which is our view here. Let's go to the next chart. What is the second one? Is default risk. So you can look at CDS for the U.S. for the credit default spreads for the U.S. And you can see here that that's the blue line. Also, it has a link back in 2021 and 2022. Both of them are increasing together, which probably makes sense. And now recently we're seeing a divergence between the two. So the U.S. nominal rates have been increasing, but the default risk has actually been falling. So that doesn't really answer a question why 10-year yields have been rising. Let's go to the next chart. Now you're looking at foreign central banks. That's the demand ask question, because foreign central banks are a very large buyer of U.S. Treasuries and a very large part of the driver of the demand side of those instruments. And you can see here that all the talk that people usually say that central banks are selling Treasuries, not true. The Treasury holdings by foreign central banks is actually at record levels right now. So what's going on? Let's go to the next chart. So the demand is not really the reason. Supply is the reason. Supply is the one rising. If you go back to the chart real quick, just so we save a number here. So we have a number there. How much do foreign central banks own of Treasury holdings? It's about $8 trillion. All right, keep that number in mind. Now let's jump two charts or two slides. There we go. And now we're looking at the total amount of U.S. Treasuries outstanding, which has increased by $8 trillion since June 2020. I'm not kidding. The entire amount that the foreign holders hold currently is actually exactly the size of how much has increased since June of 2020 of Treasuries outstanding. So if we go to the next chart, this is the most important development happening in the macro world, in the macro community, I would say, is the fact that foreign central banks are transitioning towards gold. And the white line is showing now that the foreign holdings relative to how much Treasuries are outstanding. So that is one of the most important metrics to be watching for, because we're seeing a flood of issuances and central banks are just not buying Treasuries. And I'm sorry for repeating this chart for 3 straight presentations, but I do want to emphasize that I think this is one of the most important things going on right now. And so we're seeing the bars, the blue bars, which is really gold relative to global international reserves, increasing. And when I said that global central banks are starting to show their cards of accumulating gold, that is certainly the case. And we're yet to see the traditional portfolios actually follow through. And what Kevin was referring to, of that those flows coming back to the mining industry. Remember, the blue bars here are central banks buying gold. Central banks don't buy miners. Therefore, we're not seeing those flows coming into the miners. If the main buyer of gold recently has been central banks, we're not seeing yet the general investor buying into the story of precious metals. But I do think that ultimately spreads towards other things like silver and like the miners. And so that's why that asymmetry to me sounds very opportunistic. Let's go to the next chart. So this is probably the most important chart of this whole presentation. Now, if you look at the ratio of gold to Treasuries, we can call this a cup and handle. For those that are not fan of the technical term or not fan of technicals at all, you can just see that we're actually above the levels we were back in the peak of the bottom of the global financial crisis there, in which this ratio actually fell for about a decade there, as you can see. And now it's started to move up, and now it's starting to break out. And basically, I think it's going to be chasing the levels that we saw in the prior highs, which was in 1970 or late 1970s and early 1980s, in which was somewhere close to 6 in this ratio. So there is a 5-fold potential increase for this ratio, in which I think is highly likely. That's just my opinion. Let's go to the next chart. Ratio, I love looking at ratios, and this one, it just blows my mind. I love this chart. It's just looking at NASDAQ relative to commodities. This is another way to see how this market is really a tale of two stories. It's how financial assets are so expensive, especially the long duration portions of the market. And you can claim US technology companies are one of the main drivers of that, but also how hard assets, especially commodities, are so cheap today. And this chart highlights this very well. And it highlights the potential for a rotation out of one very expensive side of the market into one that has been for long neglected. And I think that we are in the process of experiencing that. We're experiencing the inflows in commodities, not the outflows in NASDAQ. But I do think that ultimately, in order for money to come into the commodity space, we're probably going to have to see some outflows from the NASDAQ side as well. And so that's why we're firm believers of this rotation theory. And you can do another chart of this, looking at the foreign holders allocation in US equities, in which you're going to see that it is a very similar chart. The foreign holders already have a very large percentage of their assets in US equities. And so where is the money going to come from? Even if we see a large dilution of the monetary system, I think that that's also going to be highly, highly beneficial, especially for the things that are very cheap, and those are commodities. And when you see something like gold is starting to move the way it has been moving, I think we are at the very beginning of a secular move for gold, and which makes me very excited about other things. Let's go to the next chart. And now, if I could look at a chart all day long, if I had to look at a chart all day long, it would probably be this one. That's silver breaking out recently from a quarterly candle, in which you can claim that this is probably the biggest cup and handle ever formed in history, and which supposedly suggests that we're probably going to see new high prices for silver. And so when we think about buying silver mines and buying projects, we always consider, where would this project be if silver prices are at triple or at $50 an ounce or a triple digits, perhaps? Is there a possibility of seeing that? I think so. Why is that? Well, production, we know for a fact that production has been falling. And if you accumulate both or combine Mexico and Peru as a production, which was one of the largest, it is one of the largest silver producers countries in the world today, you're going to see that their production combined is down about 25% from peak levels at the same place as it was 14 years ago. So it is not just a demand story. It certainly is a supply story as well. And we know for a fact as well of how much how many new discoveries, outside of one of them that I can't talk about it. We have seen a very difficult number of discoveries, a very small amount of discoveries of silver over the last decade as well, which usually is in line with the constrained supply story for the metal over time. I think this might be my last chart, but it might have one more. Let's go to the next one. Okay, this is another one, very important one, just to finalize my point and hopefully hopefully transition to Quentin in a good way here, because this one is basically talking about how, yes, we're seeing the second wave of inflation likely in a lot of different metrics. I posed the example of oil, and then we looked at commodities equal weighted. We looked at agricultural commodities. We looked at global freight cost. All sorts of things are pointing to the direction that potentially inflation is reaccelerating. But there's another thing that's potentially reaccelerating, which is fundamentals of the gold and silver miners. And now that is something that is really off the radar. That industry, or this industry, is probably the most hated industry I know. And so to see the improvement of fundamentals with prices that in some the miners, such as Newmont, not to pick on Newmont, but that is down close to 60 to 70% from their peak levels. And there are plenty others that are in a similar position with fundamentals is starting to improve. This to me, it sounds like an opportunity and not something you should be scared away. And so I also think that second way of also interpreting this data is the potential for an M&A cycle, which we certainly have started to see recently, pretty much in line with this second wave of free cash flow happening across most of the miners. Nonetheless, I think this is a big opportunity for us investors in the space, but also investors in the exploration stocks, because most of the miners that are starting to make money are also in need for increasing and improving the quality of their own reserves. So not only central banks have to improve the quality of their international reserves, the miners also need to improve their own reserves, and therefore are likely to be big buyers of explorers in order to chase that expansion of the quality of their assets, which I think it's the main reason why we're seeing the gold miners actually underperform drastically gold prices, while we're seeing, for instance, copper mines or copper projects actually outperform copper prices. And so anyways, this is to me a very positive outlook for this industry, which we've been presenting this idea for some time now. And I'm very glad to be in the position we are of having built all these connections and these assets that we own, because I think we're onto something very special. And I think the train has already left the station. And it's shocking, but also very opportunistic to see the valuation of the miners is still as depressed as they are. So now I'm going to pass it on to Quentin Haney.
Okay, thanks, Toby. But I got a question for you guys. Okay, because I watch something very closely and have been for like 2 years now, because I see an inverse correlation between like the yield on the 2-year treasuries and the gold price. Okay, like for 2 years now, every time you see the yields go up, gold is just getting hammered. Okay, but look at this. Look at that. There we are. Okay, it's up like 0.1% today, which is pretty big. I mean, percent wise, that's like, I mean, that's a significant move. That's like 2.5% increase in the yield on the 2-year. But gold's up like 30 odd bucks. Okay, something very profound has changed in the past 3 weeks or so, 4 weeks maybe. What the heck is going on? How could yields be going up that sharply and gold is also going up? What's going on?
Go ahead, Kevin.
Oh, don't question it. Just accept it.
I'm going to answer a little differently. I'm going to say, welcome to an inflationary era. I think that's
There you go.
the beginning of
that's the answer I was wanting. Okay, cool. it was a just lobbing a little big softball at you, but yes, I
know you are.
I tested Toby on that earlier this week. So anyway, look, the tide is rising, okay, and we know that the tide will lift all boats. And here you can see a picture that kind of captures that. You can see a bunch of boats off there that are just about to get lifted by the incoming water. And then we have some boats in the foreground here that might actually start floating a little bit later, okay? As the tide goes up the shore there, it takes a while for each level of boats to lift, right?
Man,
and
you deserve an award for this stuff, Quentin.
It took me a while to find this, guys. Like I had to. This is what I call research. This is what a geologist does. He sits on the internet and tries to find the right picture. Okay, but the point is what like Kevin was saying earlier, and then Toby touched on it too, is that a lot of times we don't see that that instantaneous gratification in the junior space, especially when the tide is lifting. And I'm going to talk about that a little bit more today, okay? Because I think there's some other fundamental reasons. They're just my views, okay? But I'm going to show some ideas about what I think happens in the early phase of a bull like this. But I'm also going to show how I think people can take advantage of that. I'm not a financial advisor by any stretch, but I'm a geologist, and I've been in this industry for nearly 40 years, and I've watched this cycle go go through this many, many times, and I'm going to just give my 2 bits on the whole thing. All right. So let's go to the next slide. Okay. We've spoken about this before, where when the commodity cycle, starts to kick in gear, especially gold, and gold is rising. Okay. The central banks are driving the price, like Tavi suggested earlier. But we start to see that affect, that money start to come in. Now, it's going to take, some other shift out there on the macro level for that money to, materialize. Okay. Like it's going to take, a bust in, certain sector or at NASDAQ or whatever, for that money to really start coming in this way. But it usually follows like a waterfall or like that tide rising. Okay. It starts to lift the ETFs and the big miners first. Why? Because think about it. These folks that have this money and they look around, they're saying, well, where can I put my money now that I know that this has peaked and I want to make money elsewhere. And they say, oh, gold's gold's up, 13% this year. Wow. Okay. And they come over and they get on the Google, like Tavi said, and they do a little research and they find out, oh, there's a company called Newmont. I think I'll buy some of that. Hey, there's an ETF here, a GDX. I'm going to buy some of that. And then, a few days later, they start doing a little bit deeper dive because, these are not people that like to work hard. Okay. But they do a little bit deeper dive. And then they realize there's other miners, a little bit smaller miners that you could buy. So they start sticking their toe in the water there. And then, hence, so forth and so on. It kind of cascades down the ranks there. They go into advanced explorers, and then, last on the food chain is the junior miners and the explorers. Okay. So just to show this is kind of the way things work. I put some slides together. Go to the next slide. Okay. So here's a look at stock charts, and I clipped these this morning. Okay. They probably moved a little bit since I took the photographs, but not much. Okay, so you can see a Newmont, Barrick, and the GDX. Okay, and the candles in the background there, that's simply the gold price. All right. But you can see that all of these stocks responded sometime around the 1st of March. They're probably right before PDAC, I think it was, when gold had that magic lift on a Friday afternoon. What a wonderful feeling that was, by the way. I mean, you could just tell something had shifted. Like for that to happen right before PDAC, that doesn't happen often. Usually it goes the other direction. Anyway, you can see how much of a lift there's been through that period. Now, I extended the chart a little bit further back just so you could get a sense of where these companies were at, say back in February at the low point, when everybody was going hara-kiri and thinking the world was going to end and mining was never going to ever come back. And you can see how things turn. Wow, what a shift, man. I mean, these things are up, 15, 20% or so. I can't read the numbers, but, you can see the big moves. All right. So those are the big companies. That's the GDX. And that's what people usually jump into as soon as they hit Google and they look up gold, where can I invest? Boom. There's the ones that move. Go to the next slide. Okay. Let's go to the mid tiers. Look, these are, just a handful. And I'm not, I just came up with whatever popped in my brain, when I decided to make the slides. So I picked a couple of mid-tier producers. One's Sentiment, one's Equinox. And then I also picked the GDXJ because the GDXJ does have a lot of mid-tier miners in it, gold miners especially. Okay, and you can see these things also moved up, but there's a slight shift. Okay, like, again, about a day or two later, when people start to figure out there's other things you can invest in. All right. So if you compare, you can take your time on YouTube over the weekend. You can go back and look and, yes. Oh my goodness. Look at that. The jump into these companies was usually, into the first week of March, we'll call it. So a few days later. All right. But they're all up. They're all up big time. In fact, they're probably up more than Newmont and Barrick are, quite frankly. Let's go to the next slide. Okay, then let's go down the food chain a bit. Let's go to what we'll call advanced explorers. These are companies, and these happen to be 3 that we have in our portfolio that have also responded to gold price, but not quite as resoundingly as the ones I just went through. Okay, why? Because most generalists don't know about this level of investing in the gold space. It's just not like to understand, oh, there's this big discovery in Yukon, this valley deposit in Snowline. I mean, that takes a little bit more legwork, to understand that. But, people are starting to catch on, certainly smart money. You're seeing people pile into these things. Newfound today had a pretty good run, by the way. And, I talk about that more in a minute. I think what you're seeing when you see Newfound run big on a day like this, yeah, it's partly gold, but it's also partly this magical discovery of these generalist investors out there getting onto Google and doing a little bit more in-depth research and learning more and more and more and going, wow, I got to have some of that. They find these companies, and then all of a sudden you start to see that tide catch these companies and start lifting them. Good story, especially when you got good news like Nevada King had some exceptional drill results this week. Yeah, they saw a huge lift, but prior to that, they were kind of waffling around, up a little bit, but not up hugely. Okay, but these are, you can see the timeline for these. You saw more a gradual increase in March, and then more of an uplift here recently. Okay, all right, let's go to the next slide. Now we get to talk about the junior miners, and this is one of my favorite South Park episodes. I've shown this before. It's the one where you have all the folks, homeless folks, looking for change and wandering around South Park, like zombies, looking for change. I count the junior miners in this league. Not to disparage junior mining. Look, I love junior mining. I love exploration. Don't get me wrong, but there's a lot of junior companies out there, a lot of explorers, however you want to call them, that are basically out of money right now, and they're looking for funding because they need to keep the lights on. They need to keep going. Now, I heard a stat this week, and I don't know where the source came from, but somebody who's pretty familiar, a broker is familiar with the junior space, told me that of the roughly 1,500 junior companies listed in Canada, that 70% of them have less than $70,000 in the bank right now. That's crazy. I mean, that means there's something like 1,000 companies out there with barely enough money to keep their electric bill paid. Okay, so what does that mean? It means we're going to have to see some finance come to these companies. So let's talk more about this. Let's go to the next slide. Okay, so what happens to these poor companies that ran out of cash during this down cycle? The past 2 years have been brutal, and a lot of companies ran their treasury down to a dangerous level. Say sub $100,000. Some didn't. Okay, I mean, it's really on a personal level that people decide where their comfort zone is. some companies they saw this route and they're just like, I think we're going to stop spending money. And they still have a few $1 million in the bank, $2, $3, $4 million in the bank, and God bless them, because that's brilliant. That's what you need. I think they're going to be the first ones out of the gate if they have money and they can get back on their feet. Yeah, they got an advantage. Okay, but there's a lot of companies, a lot of them, like 1,000 that are basically down to fumes, and they're going to need money. Okay, and the problem with that, guys, is people know it. Especially the brokers, the bankers and such, and even a lot of retail investors who are pretty savvy in this business, they know those companies are going to go out and have to do a financing. Now, I want to be really clear here because I don't want anybody getting me in trouble here today. So I'm not going to speak about financings in any specific company or anything like that. And I'm certainly not giving financial advice here. Okay, this is my view. It's just my picture, my view on what I've seen over the years. We, just to be really clear with folks, we here at Crescat really can't talk. I mean, we're restricted about talking about financings and such on videos. Okay, like just purely, if it's a specific financing, no, we can't talk about it. Okay, like we can't be seen to be meddling with the company or trying to manipulate stock or whatever. That's not what we're about here. In this case, I'm just simply presenting a view of how I see, a typical junior mining company that's kind of on its back, going through a process to get back on its feet. All right. And this also explains why we don't see the big lift in the junior companies, these exploration companies, early on in these cycles. Okay, it takes a little while. Why? Go to the next slide. Okay, so I put this little chart together. It's very schematic, but it shows kind of the pattern you often see with explorers who've been through a very dark period like this, very protracted, lack of capital in the markets and such. Their share price gets depressed. I mean, basically, everybody's gotten beat to death over the past two years or so. Okay, but then all of a sudden we see this magical event happen. Like I said, the Friday before PDAC, the gold price rallied, and it's been quite a ride for the past 5 weeks. Okay, this isn't a little ride. I think, given what Tavi and Kevin have said, I think we're into a full-on breakout. It's not, I don't want to jinx anything, but I don't think this is a fluke, guys. I think, the fired, like we've been through 19 or 20, sucker punches where, gold or whatever ticks up a little bit and then whack, it gets, like, oh, here we go again. Well, I think, knock wood, I think we're past that now, or we're going to be past that. And I think we're getting, getting our skates on and getting back into the saddle here, so to speak. All right. But these doggone junior companies, because they don't have any cash and they don't have any income, they got to go through a process. And what that process usually entails is getting the bejeebers knocked out of them. Okay. They get beaten up because everybody knows they need money. All right. So you see, even though their price is depressed already, they often get beat up more because people know they need money. Okay. So when the company needs to go out and do financing, you see a bit of a letdown in the share price. Why? Because people are going to sell. If they hold that share and then somebody comes to them and says, hey, we got to do a financing. A lot of folks, like, we don't necessarily do this, but a lot of folks just go, oh, I'll sell all of those and I'll buy, again in the placement. That's how it works, guys. It's unfortunate. That's just the fact. All right. So they get beaten up. All right. So they might lose 20, 30% of their value, beyond the already depressed price they're at. But as soon as they pull that Band-Aid off, rip that Band-Aid off and get that financing going, you often see, at least in times like this where, metals are ticking up and everything's starting to get back on its feet, you often see a rapid rise in the appreciation in their share price, the market cap and so forth after that. Okay. Why? Because as soon as that Band-Aid's ripped off, everybody knows, hey, this company now has cash and they can go out and do their business. Their business is to go out and explore. All right. So this is part of the process, but I think we're seeing a lot of Band-Aids just yanked off right now. And we're seeing a lot of little junior companies, as money starts to trickle into this space or trickle down the food chain. We're starting to see a lot of these companies, pop up. I've got in the past 4 to 5 days, I've got probably 100 solicitations for different financings. It's jaw dropping. Okay. It's jaw dropping. Yeah, it's exhausting actually. I'd love to help everybody in some ways, but on the flip side, we can't. It's just not possible. But we're going to be selective. We're going to pick the right ones and we're going to make a lot of money because I think the money that we will allocate, when I say, look, I've got to be careful what I say. I think we will do well because I think we can pick the right companies to invest in that will have those discoveries. You see how the train goes up, they get back to work and then they start drilling and they make discoveries and da. I think we're going to pick the right horses in this race. Okay. So that's where we come in. All right. So if you want to look at, individual companies and pick your own, great, go for it. But guess what? Here at Crescat, we can do a lot of that for you. We can save a lot of pain and anguish. Okay. That's what we're about. And we like to pick those companies. We like to allocate money into them so that they can do their work and make discovery and then get back on that Lassonde curve. That the rest of the chart here, that's the Lassonde curve. All right, let's go to the next slide. Now, in the world of financing, they often use the term, the window is open. Okay. There are periods where there is money coming into the space. And during those periods, all the bankers, all the junior company executives, well, at least most of them, know there's money coming in and they are ready to leap through the window. Like they want to grab some of that money. Okay. Now, everybody also knows that that window can shut at any moment. Okay. So you often see just an absolute, like race to get money when the window opens. I remember working at Newmont when Pierre Lassonde was there, and he used to refer to it as a cookie jar. And he used to say, when the cookie jar is open, you take a cookie. That was his metaphor for what you see in the financing world and the junior explorers. It is what it is. Okay, right now the window is open, so everybody knows. Okay, so that's kind of what I'm trying to tell you is that that beat up thing and whatever. As soon as you see these companies get beat up and they do a financing, happy days. I mean, you're not guaranteed, but oftentimes they start to appreciate from there. Okay, so as an investor, you want to be able to take advantage of that dippy do, and especially when the window is open. Okay, all right, let's go to the next slide. So I'm going to give an example. I'm not talking about financing per se, but this is a company that we know well and we've supported for many years, and we back. And they did a financing. Okay, I'm not going to talk specifically about it, but I'm going to just show you the pattern that we see here. You see the stock come off there a bit for a few weeks. Why? Because people knew they needed to do a financing. They kind of hit a trough there, but as soon as there's investors out there ready to put money in, guess what? She takes off again. Okay, no promises here, but I would say that if we come back in 3 or 4 months, because this company now has money, that chart hopefully will continue, as they get back to work and drill and do all the work they need to do, that chart will continue to move northward from here. Okay. It's just the way it is. All right. All right. Let's go to the next slide. Now we have a number of silver explorers. It's funny when I'm talking about this. Guess what? I just got a call from a broker. He wants to sell me on some deals. It's nonstop, guys. I mean, it's unbelievable. I have to just tell people, no, thank you. Anyway, a couple of weeks ago, I talked about silver explorers. Okay, and it seems like ancient history now, but it was only 2 weeks ago. And if people want to go back and listen to that, they should, because I think this list has some pretty good ideas on it. All right. And yeah, some of these companies are going to go through that process, and I don't know which ones and when and how, whatever, but there are some silver stories here that could be very interesting for folks. And I really love all of the companies on this list. Okay. These are companies in our portfolio. I've worked hard to pick these. I think the management teams in most cases are very good. Technical teams are good. The projects are fantastic. They're in jurisdictions where you can build mines. I think these ones will do well. Now, why did I put silver explorers up here? Because this week I've gotten so many incoming emails just asking me, what silver stocks can I buy? What is out there? I want to know silver. It's like Tavi beating on the table and frothing at the mouth about silver, and it's like, I'm just going to throw this slide up and again so that people know my list or our list of silver stories or silver exposure that they can stick their toes in. Okay, there she blows. All right. Yeah. Okay. Let's go to the next slide. Now we here at Crescat, I'm going to say we're also back in the saddle. Okay. I haven't been able to talk that much lately about new investments we take for many months there. This is going back a year or two. I was able to talk about, every other video or so about a new investment we would make. All right. What's the story they're in now? Hey, that was fun. Okay. But the money has been pretty tight for the past while. Okay. It's just the way it is. But we're starting to see that money come back. This isn't a message to every broker out there to start calling me, because I don't want my voicemail full. But we are starting to allocate money. Okay, now I'm going to harken back to something I said a few minutes ago. We're not just throwing money against the wall and seeing what sticks. Okay, I want good stories, good explorers, good management teams, good projects, etc., that I think will deliver huge value. Okay, I want the winners. I want those horses that are going to be winners. Okay. And we are going to be able to start talking again here soon about some stories as we invest in these that I think are winners. Okay. So fun times are coming. Okay. This, with a bit of money comes the ability to start talking about this. We'll call it the next generation of explorers that we think could do quite well. Again, I can save you a lot of pain and anguish, researching all these. Just come to us. It's pretty simple. All right, let's go to the next slide. Okay, now we got to talk about, go to that next slide, unless I'm frozen. No. There we go. Update. Okay, updates. I'm going to talk about a few updates this week. Look, one of the things I've noticed lately is that there's a lot of new people watching our videos. We kind of changed our format here recently, and we changed things, and we're trying to make it more broad scope for more people to watch the videos. And not that we're changing our presentation that much, but it's we recognize the market's turning. We're trying to gussy ourselves up, get ready for this dance, right? So we've changed a few things up. I think they're for the better, but I have to reflect on the fact that there's a lot of people watching these videos. They're like, who the heck are these yahoos? Like they don't know anything we've talked about over the past 2 or 3 years while we've done this videos. And I'm probably going to have to go back and actually touch on a lot of basic, discussions around junior mining and so forth that I've talked about over the years. Some basics are about geology and mining and, companies and their projects and deposit types and all this good stuff. I'll probably have to kind of rekindle that and start, retelling some of these stories. But when we do these updates, what I'm talking about are companies that we have in our portfolio that had news in the past week or two. Okay. That's what this is all about. So those of you who are watching this video for the first time, these are updates about stocks that are in our portfolio that had some news that I can talk about. Okay. It lets me talk to you guys about an update on their advancement. Let's go to the next slide. Okay, one of the companies that we jumped into in a big way, and it was right following Snowline's discovery at Valley, was Rackla. Okay, and it's based on the premise that the Tombstone Belt up here in the Yukon and even on into Northwest Territories, that this belt is going to be a prolific region of gold discovery for the next generation of gold mines. Like this is ground zero for discovery. In my view, this gold cycle is going to be partly underpinned by the discoveries that are made in this region. I talk about a lot of companies. I talked about Sitka, I believe, last week. Wonderful story. A lot of time people come to me and they say, well, you didn't talk about, Sitka today. Well, do you not like Sitka anymore? And no, that's not how it works. I talk about companies that have news. Okay. So I love Sitka and I love Rackla, and Rackla happened to have news this week. All right. So I'm able to talk about it. Okay. And what Rackla is looking for is one of these reduced intrusion type gold systems, much like Snowline has at Valley. Okay, now in this map, you can see that they are further to the east from Snowline's area. Snowline is over there at Rogue. But we are over here in what's called the Astro-Plutonic Complex. Sounds like what kind of name is that? I don't know. Some geologist came up with. But it's basically a large granite mass buried in the ground where these intrusions rose up from it, and they created gold deposits in many cases. Okay, so our buddies here at Rackla have managed to secure a commanding land position over this Astro-Plutonic complex, and they announced some targets that they've developed with data they collected late last year that are killer. Okay, go to the next slide. Okay, so we are at what's called the Kelvin stock. So basically, this is an intrusive that's expressed here in geophysics. You can see magnetics in this case, and oftentimes these intrusions have low magnetism, which in this case shows up as blue. They often have a halo around them where they've cooked up the rocks and they've created highly magnetic rocks as over the roof of them, over the top, and sometimes around the margin. Okay, so the big pink areas that you see are basically highly magnetized rocks that are a product of getting cooked up by the intrusion. Okay, but they've defined a target here at this Kelvin stock, or I should say targets, including peak, which we've talked about, but also the circ target that I think are absolutely killer. They have every single ingredient that we saw at Valley in the early days. Okay, so this is a story where the company could go out, drill this year, and make a major gold discovery. And I truly hope this data is telling us such. Go to the next slide. Okay, so here you can see the mapped extent of that intrusion. It's basically the red thing there. Okay, but you have these areas around it where there is very strong gold, but also trace elements that one would expect with gold in this kind of system, particularly bismuth. Sometimes you see tellurium too. Okay, but in this case, bismuth. And these guys did a lot of work there last year that generated some wonderful targets. Okay, the peak target is over here on the fringe. It's on the margin of the intrusion. But if you think in 3D, that intrusion probably dives underneath peak. Okay, so the fact that they found a lot of rock samples at surface that are high grade, as well as get a lot of soils that are telling us there's a lot of gold there, that might be telling us that there's an intrusion underneath peak that could prove to be like a valley type target. So there's one target. The second one that I think is just killer is this circ target. Okay, what is a circ? Well, when a glacier scours out a mountain, it usually leaves bowl-shaped valleys up at the head of the glacier that we call cirques, literally cirques, like circle. I think it's a Swiss word. But that cirque is often filled with glacial stuff like till and stuff like left behind by the glacier. So you can't sample down in the bottom of the cirque, but you can sample along the margin. Okay, and what these guys did is they did soils around the margin of that cirque, and they're lighting up like you wouldn't believe. I mean, look at these numbers. These are crazy. These are very strong gold numbers in the silts and soils around the margin of that cirque. It's well within the intrusion, guys. Okay, in my view, that's telling us there's a lot of gold shedding from that intrusion. And hopefully that means we have a sheeted vein complex. And I think, I think what they're trying to express here with the black lines, the little thin black lines, is that they see the sheeted veins. Okay, so this is code word for holy moly, this could be another valley. Okay, I woke up when I saw this target, and everybody else did, and everybody's super excited about it. And it could be one of the most exciting drill stories in the Yukon this year. Okay, let's go to the next slide. Okay, Fathom nickel. Now, nickel hasn't seen the big burst that gold has and stuff, but it is moving up. It's moving up. Okay, it's kind of hit its low and it's starting to move up. And we do have some nickel stories in our portfolio, and one of them is Fathom. Now, Fathom managed to raise some cash. It was very, challenging back in December to raise cash, but they managed to raise, I think, like $4 million or so, and that gave them the budget to go out and drill. Now, they drilled Albert Lake, which is one of their targets, a few weeks ago, and now they're drilling at Gawkager Lake, which is another nickel target to the south of Albert Lake. Equally intriguing. And guess what? They took all that data they had previously, all that drilling and geophysics, the downhole geophysics, seeing the conductors off the margin of their drill holes and stuff. And they've been very successful at hitting sulfide intercepts. I think every single hole that they have in this news release, all 4 of them ish, hit pretty good intervals of sulfide. And the market reacted like this was no news at all. And it is baffling to me. I mean, this is crazy because I see this as really good. I see those sulfides, those kind of brassy looking sulfides there, is very prospective, very promising. In places, they're almost massive, like they're almost solid sulfide. And this is telling me that they're onto something. Okay, have they made the big discovery yet? I don't know, but they're pretty close to hitting something here, in my view. Let's go to the next slide. Now, I asked the one really nice thing about working with some of these companies is there's people that are very responsive, and Doug and Ian are very responsive. And I asked Ian to tell me how I can help tell this story. Okay, this is a bit of a techno dive, but I think it should, if I walk people through it, it should show you what the heck is going on here. Okay, now, first of all, the image right in the middle, I want you to fixate on that. The blobbies of light orange and darker orange are basically our nickel mineralization. It's kind of a halo of low grade with some high grade within that. And in places it's very high grade. Look at, look at look at hole 3 there, 23003. What is it? That's oh my goodness, I can't read the numbers. 58 meters of 1.49% nickel. Okay, that's a wonderful intercept. There was higher grade within that, 18 meters of 2.43. Okay, so we know there's a blob of high grade up near the surface. And see that gray thing that's kind of in 3D that's projecting through that? That's our conductor. Okay, that is how well the conductors, when you do the downhole geophysics, and you can see that, that's how well they're expressed. Like you can pretty much nail it. If you have one of those plates, those conductors that is defined by the geophysicist, you can drill across it and hit, at least in this deposit, with very high probability. Okay, that's encouraging. Now, that conductor is open along strike. Okay, the fact that it's just drawn as a little rectangle right there, no, it's open along strike. Okay, so we know the thing has strike continuation. All right, but we also see down at depth, the company tested some of the deeper conductors. Okay, they saw them down there with geophysics they did last year, and they came back and they drilled some holes across, very carefully crossing those plates. And guess what? They see sulfide. I mean, holy cow, that is wonderful, proof of concept there. Okay, now again, those rectangles are not closed off, guys. They continue along strike. Okay, so rather than kind of walk you through all that verbiage on the left-hand side there, my point is they are seeing more and more sulfide, and very successfully with the geophysics they've done, chase this thing. Okay, now what they need to do is they need to chase it along strike. It is nearly vertical, the whole system, but they should chase this thing along strike. And as they drill more holes and get more data, they can start to see those conductors expand. And at some point, I'm very confident these guys are going to hit something big. Okay, I really think that they could nail it. All right, so that's the story. So the news that came out this week, in my view, is very good. Okay, next slide. Okay, Brixton had a news release this. In fact, I think it was last night. And the news was actually out of Ivanhoe Electric, who are earning into the Hog Heaven project in Montana. And Ivanhoe, as part of their earning, they chip away at this thing. They drill some holes here and there and now and again. And they've kind of fixated up in that northern area. You can see over here in the map on the right, in that little tiny box, they fixated in that particular area. It's not to say the rest of that geophysical expression isn't prospective. Okay, that's conductivity, by the way. This is not magnetics, but it's basically measuring conductive rocks that would be likely associated with a big porphyry, epithermal system of some sort. But they keep hitting better and better results. Now, one of the measures I have for a project, if we see successively better and better and better results, usually those are the projects that end up leading to discovery. Okay, think about it. If you it's just like Fathom. Okay, if you kind of take the data you have and then get smart and then drill some more holes and you see better results and then interpret again, eventually that will lead to a discovery. And I think that's the path they're on to here. Now, what did they hit? Well, they hit 82 meters, 0.63% copper, 0.32 gram gold, and 38 grams silver in one of the drill holes. All right. Now, you might say, well, that's okay. It's not a huge interval, but it's better than anything that's been hit so far. So it tells me that they're getting smarter and smarter, and they're starting to see where this thing's going. Go to the next slide. Here you can see a long section through, this is like looking at a slice through the ground, right? We're looking at all the drill holes from the side. Notice there's some drill holes in the blue that are assays pending. So we should wait for more news here. But, all of these holes have hit mineralization. At this most recent one, this intercept that was just announced, which over here in the chart, I believe is hole 14. Yeah, hole 14. Hit, pretty good run. Look at all those numbers. You got, that's not bad. Copper equivalent, that's 1.22%, by the way. That's okay. Now, notice they also have some interesting results in the other holes, okay? And, hole 11, which I think was a ways back, I can't remember when it came out, but it hit 210 meters of almost 0.6% copper equivalent. Okay, so there's a big system here, guys, and they've really only tested a narrow scope on this thing, but I think as they expand, they're going to see something interesting turn up. And one of the things that really has me intrigued, and this is kind of going into geo nerd land, okay, is the style of mineralization. Okay, that photograph over here in the lower right corner is of some of the mineralization they've hit in hole 14. It's some of that higher grade stuff. And it happens to be sulfides with a mineral called enargite, which is a copper arsenic sulfide. All right, but it's typical of high sulfidation systems. And I'll be darned, like when I see that, I'm thinking, man, imagine if they hit about 100 meters or something like that. You can go back to the chart there. The highest assay in that hole is at 9.65%. It's 3.9 meters of 9.65% copper equivalent. Okay, so they hit a little taste of something in there that's very high grade, like super interesting. Okay, that reminds me, and no guarantees, but it reminds me of what I saw out of Reservoir. Thank you. Just popped in my brain. Reservoir in Serbia back in 2013, I think, when they found I can't remember the name of it now, whatever it was. It was a big high grade, basically high sulfidation system at depth, a blind system. Guys, I take note of this. I look at the geology. This is the attention we give to stories like this. I'm sticking with this one. If they hit a reservoir type discovery here, and I cannot think of that. It's next to the Bohr mine. I can't think of the deposit name. Anyway, this could rock and roll. This could be a major, major discovery. Okay, go to the next slide. We got to get our skates on. I just realized. Okay, Newfound. This is the least astonishing news release I've ever seen in my lifetime. Okay, why? Because it's the metallurgy from Newfound. Okay, now the company has been drilling for 3 years or so, I think. And every news release they put out, they have wonderful pictures of core with visible gold. When you see visible gold, and look, I got to do a recap of metallurgy for folks sometime, okay? But when you see visible gold in the core, that means it's free. It's not bound up in sulfide or some other weird thing. It can be liberated very easily. And we knew this from day one, okay? I used to be a director, and I was like, okay, the metallurgy should be pretty good here, okay? And guess what? They've done the work now to show it pretty good, like 90 to 96% recoveries. You can see over here on this table, it looks very confusing, but basically what they did, okay, is they took these samples, they took pieces of core over long intervals and made composite samples. And then they tested material from different areas, and they ground it at different sizes. So 212 micron, it's kind of like coarse sand, 75 micron, it's pretty fine sand, and 53 micron, they're like really fine sand. And by the way, this metallurgy program was developed by Gary Simmons, who was the former chief metallurgist in Newmont. He was there when I was there, so I know Gary quite well, one of the smartest guys on the planet. He developed a scheme to see if they could liberate the gold at fine particle size, but also at coarse particle size. Why? Because if you can grind the rock to a coarse particle size, it saves a lot of energy. Okay, saves a hell of a lot, or heck of a lot of energy, and that means cheaper costs of processing. Okay, and guess what? If you look at the recoveries here, the gravity concentrate extraction, that tells you how much of the gold they captured just in a gravity concentrate. This is like putting it through a Nelson or something like this. Most of the gold comes straight out into that concentrate. Most of the gold, and that's to be expected. It's a coarse gold deposit. Okay, but then they took the tailings from the coarse gold extraction and they put it through CIL, which is carbon in leach. It's basically a cyanide leach, digestion to capture the rest of the gold. And they were able to capture the rest of the gold, ending up in a weighted overall extraction. That third column from the right, that's your extraction. Now, here's the interesting part. Even at 212 microns, they're getting about as good a recovery across the board here as they do at 75 microns or 53 microns. What does it mean? It means they could probably do a fairly coarse grind here and get good recoveries. That means cheap processing, guys. And it's not refractory. It's very free milling. You should get very good recoveries. This is a wonderful deposit. This kind of information, when it gets out and gets into the hands of major mining companies take note. They say, wow, that thing, they can start, playing with numbers. They can, oh, it's going to cost X amount to process this rock, da, da, da. And it gives them the data they need to start getting more interested in acquiring this project. Okay, so this is essential stuff. It's also essential for retail investors to learn as much as possible about metallurgy, because it's really the most important aspect of any discovery. Okay, let's go to the next slide. Nevada King had some results. They are off to the northwest from the pit. In this image here, you can see the pit boundary with the little hatchers. It's off to the northwest in an area that's seen some drilling, but it's targeting some high grade. And one of the things they've learned here is that there's certain structures that apparently fed the fluids or whatever, they generate high grade results. And in this case, they got 4.51 gram per ton gold over 86 meters and 7.77 gram over 43 meters. Holy guacamole. Those are killer results, It's all oxide, meaning it's going to be readily cyanide leachable, la, la, la. This is wonderful stuff. Okay, let's look at it in cross-section. Next slide. Sorry. There we go. So you can see we're looking through a pretty wide swath of drill holes, but you can see they've got some near vertical structures there where they've hit these high grades. And the company has literally, tuned in to identify those. Why? Because if you drill those areas and you hit high grade, you can better assess in your resource estimate how much influence that high grade has. When you're doing a model, if you can understand where that high grade is and where most of the gold is, quite frankly, all the better. Okay, because it means your model is going to be better and it's likely going to generate a lot more gold for you. So yes, these are great numbers. They're infill, but they're very meaningful. Go to the next slide. Last story today. Red Pine. This is a story, it's puttering along. They do have some money in the bank from what I understand, because they raised some last year. But they hit 4.53 meters over 11.5, gram per ton gold over 11.5 meters. Not a huge hit, but it does infill an area along the main part of this deposit. Now, this company is going through an experience that a lot of junior companies go through in a really down market. Okay, sometimes people get very fatigued running a company, and look, Quentin is a great guy and stuff, and wish him well. But he decided to hang up his spurs, and they're out there, looking for a new boss for the company. And I think just listening to the rumor mill, I think they're going to find some really nice, strong technical folks to come in and likely fill those shoes. Okay, so that's going to be an important part of the kind of rejuvenation of some of these companies too. Seeing some new management come into some of these companies that have been beat up and have value, but they just need the right hand at the helm, right? So, okay, guys, that's it from my side. Sorry it took a little longer, but that's it.
No problem. It looks like Kevin isn't okay. Kevin, go.
No worries. Thanks, Quentin. All right. So, again, if you're interested in learning more about Crescat's investment strategies, while we cannot, we don't give any individualized investment advice. We're not giving investment advice on these calls. These calls are about the generalities about our strategies, about mining. We talk about the companies that have news, both the good and the bad that we're invested in. We talk about our ideas. We talk about macro, but we're not providing individualized investment advice. If you're interested in talking with us more about our strategies, and we can give individualized advice, one-on-one. So give Merrick a call, and we can talk about your interests, your needs, and see if our strategies in any way might be a good fit. So, look, we think it's a great time to be putting money into mining stocks. Obviously, you've heard, we think there's a lot of risks in the marketplace out there at large, especially, S&P 500 kind of stocks, mega cap technology. Valuations are excessive out there, and there's a lot of momentum and chasing of hot AI related mega cap techs. Things are pretty frothy, and inflation is picking up. So if you're interested in getting some inflation protection, having some gold in your portfolio, doing, getting involved in what Quentin talked about, hand-picked exploration stories that we think are going to be some of the biggest and best discoveries out there and lead to viable new mines, new mining deposits, companies that the major mining companies will be interested in potentially acquiring. This is what we're all about here at Crescat. We're about macro. We're about mining. Give Merrick a call. Tavi, any final comments from you?
Yeah, very quickly, someone in the comments said something about a question if we think this move in gold is sustainable, or is it going to be like what we saw in 2020? Look, I don't think we've been accumulating equity positions in all these companies for so long if we didn't have the view that this would be a sustainable move, and if not a very secular type of trend for gold and the miners. And so, when we think about the gold has been the big mover, first big mover in our opinion, and other assets that are linked to gold are likely to follow. And we can talk about the metals that are linked to gold, such as silver, even copper or platinum, and so forth. But more importantly, what is even more undervalued, in our opinion, is some segments or the entire mining industry. And when you think about what's happening in the world, just very simplistically speaking, with the deglobalization trends escalating, and you have not only accumulation of gold as a neutral asset, but also this reshoring trend with really high construction developments happening globally, starting in the US, it's hard to believe that the metals and mining industry is not going to be a much higher percentage of global equity markets in the future. So that's really if it boiled down, that's really the idea. And so if we think that way, we want to be activists and try to take advantage of things that are intrinsically positive and look fundamentally sound for us, and accumulate those over time and try to propose changes in those companies as we work with the executives of each of those businesses. And so the macro reasons to own this whole industry, in our opinion, is very compelling. And now even the technical side is also looking very compelling. So that's just my 1-2 minute pitch on answering that question. But not to keep this presentation too long, thanks everybody for watching. We're going to be back next week. Thanks, Kevin. Thanks, Quentin. If you have any questions about Crescat, you can, I suggest you to talk to Merrick. But thanks everybody for watching. We'll be back next week. Thank you.